Excellent. So again, I'm not going to read this to you. This is our qualifier relative to making sure you consult with your independent, either auditors, professional lawyers, or others who you use for consultation purposes. And these interpretations that we give you today are subject to change, and you know they have been for the last 13 months by both federal and state representatives. The agenda and the presenters, John Miller and I will be speaking about the New York State budget. I think it was fortuitous that we originally were going to schedule this for the end of March, thinking that the budget would be passed as of March 31. It was lucky on our part that we made it for today, with the budget having been passed just this past week. And we'll talk obviously a little bit more about the provisions in the budget that each of you may be concerned about. Back. There you go. So again, I think you all know Jeff Paley. He's presented in the past. He's our guru and subject matter expert on COVID relief programs. The same is true of Margaret Lally with respect to health and human resources, health and human services and the infrastructure. We will take that lunch break at 12:15 to 12:20. And then someone that you haven't seen in recent months, but you've maybe seen before, Paul Mayer is the head of our Compliance Solutions Group. And then the CFR cost reporting updates and other matters that may be of interest to you will be Terry Phillips, and that'll be after lunch. And Mike Vollmer will be the individual who will be posing the questions. And we would like very much for you to ask questions and submit those questions to the chat box. Next slide. I'm very pleased to announce, and this will be brief, and then we'll have a little bit more for Ethan maybe to say before the lunch break if we have time. Many of you know Ethan Kahn. He's the former not-for-profit and governmental fund sector leader for Mazars and Company. He joined us this past week on April 1st. We are thrilled to have Ethan and his talents brought to the firm. We now have what we consider to be an unbeatable team of Jerry Archibald, Ethan Kahn, Joseph Weinberger, and Terry Phillips, serving our clients in the tri-state and city. And obviously we have many, many others in our New York City office that have expertise. But this was a major, if you will, add for us. And many of you know Ethan, and if you don't, we've given you a snapshot from his bio here. And having been the partner in charge and service line leader of the nonprofit practice at Mazars USA, a national accounting firm, he also had his own accounting practice prior to joining Mazars. So welcome to Ethan. He's on the screen there waving at you. And if we have time just before the lunch break, we'll give Ethan a couple minutes to say a few words. So on to the New York State budget adopted April 6th. We have open questions yet to be answered. And again, the big one is probably where we stand with respect to Governor Cuomo and the issues that he is facing and what that may do in terms of his future decision making. But first and foremost, we want to emphasize that there remains a lack of clarity with respect to how the rescue plan stimulus monies, which were estimated by Senator Schumer at $30 to $50 billion coming to New York, are going to be allocated and expended, and in what period of time. The budget that was just passed on April 6th had a $24 billion add-on for monies to be expected for state and counties. So that certainly increased the budget to $212 billion. Never been in excess of $200 billion in the past. So the future here, and probably the next couple of webinars that we do, we're hoping to get clarification on these matters that continue to be a little difficult to get true, if you will, definitive answers on. The third bullet here, with respect to the $15 billion budget deficit that Governor Cuomo announced last July, and in his daily briefings, he continued to emphasize it right up through the end of December. In the middle of January, Comptroller DiNapoli basically put out a document that said that the budget deficit for the fiscal year just ended March 31 was going to be somewhere between break even and $4 billion. Now, as you know, government has the ability to use cash basis of accounting. So deficits and surpluses for government entities can be very, very different from what we are all used to in the accrual basis of accounting. The materials that you have for today are going to be posted, the slide deck, the attachments, and the recording, hopefully by the end of the day on Monday or first thing Tuesday morning. Some of these things are time sensitive. We realize you want to get them out to other people within your organization, and we are going to put that information out, give you a link to both the slide deck, the attachments, and the recording as soon as possible. As attachments to the slide deck, I just wrote an article for the Rochester Business Journal that I think would be helpful for all of you to read and provide to your board leadership. It discusses the issues of clawbacks, double dipping, recoupments, etc., which Jeff is going to go into in a little more detail here in a few minutes. But it also has a series of questions that we believe are appropriate for your audit committee to be asking of your auditors. So that particular piece, as well as this slide deck, I think would be very helpful for your board leadership as well as for your senior management team. In terms of questions that we think have been answered, I do believe that if somebody had said, myself included, on March 12th of last year, that they could have envisioned $6 trillion of federal stimulus and another $2 trillion proposed for infrastructure, I believe that that person would have been told that they were crazy. But yet, in fact, that is what has happened. From March 12th of last year, essentially through March of this year, we have not only the $6 trillion having been adopted by the federal government, but we also have the $2 trillion being significantly promoted by President Biden, Vice President Harris, and the rest of his administration. We do believe, at least through January of 23, which is when the midterms will take effect for the House and the Senate, that New York is in a much better position with a split Senate, with Kamala Harris making the deciding vote in the event of 50-50, which it looks like we'll have a fair amount of 50-50s, and a fairly decent advantage to the Democrats in the House. So you can expect that President Biden knows that he's got essentially 12 to maybe 14 months into next summer to get his agenda through from a legislative perspective or through executive action. So you can expect to see a wild ride here over this next year, which is why we are projecting that we will have monthly webinars of this nature. The big one, unknown as it relates to breaking the deadlock in the Senate, will be whether or not Mitch McConnell will have to use his scorched earth approach if the filibuster rules are circumvented by the Democrats. That'll be a very interesting process to watch, and I don't have a prediction given the fact that the filibuster rules have changed dramatically over the course of the last 3 or 4 decades. The days of somebody standing up and talking for 26 hours or more are behind us, and the filibuster is much different than what it was back then. And then, as I mentioned, there will be more stimulus. One of the questions that will be addressed today is what some of our panelists believe might be coming further, particularly in terms of the provider relief funds, as well as some of the other matters that have been put forth in the most recent Biden American Rescue Plan. Next slide. So, top 10 things to know regarding the adopted budget. The legislators, this is a little bit tongue-in-cheek, apparently thought that passing the recreational marijuana law in March was more important than the $212 billion budget for the state. Seemed to get a lot more attention in those last 2 weeks of March. But we do now have recreational marijuana, which is going to be implemented over the course of the next 1 to 2 years. And I think the projection was that it was going to add hundreds of millions of dollars of new tax revenue to the state. I mentioned earlier, but I'll say again, that all of what we say today could be seriously impacted by whatever happens with Governor Cuomo with respect to not only his political issues, but the allegations that he currently faces. And it's important that you recognize that this is still a roller coaster ride and certainly a moving target in many of these areas. The 30 to 50 billion that I mentioned earlier that Senator Schumer has been promoting, it is still not clear, but it will, if received, alter the future decisions regarding Medicaid funding. You'll see in the subsequent slides here that the across-the-board cut was rejected. The CCO cuts were rejected. The influx of cash from stimulus definitely moves the legislature as well as Governor Cuomo with respect to some of the draconian cuts that were talked about last year, not the least of which was the 20% withhold that you were subjected to back in October or August, I guess it was. That 20% withhold, I believe most folks have now received those monies, but certainly impacted you negatively from a cash flow perspective. We're now at $83 billion for budget purposes for Medicaid. We're approaching 7 million New Yorkers that are eligible for Medicaid, and that's approximately, not yet 30% of the population, but it is not sustainable beyond this term of stimulus as we go forward. So those of you who are feeling comfortable and having significant available cash from the various stimulus programs, I believe what the COVID-19 pandemic and the stimulus has done is it's pushed what we thought was going to happen in the latter part of 2020 into at least the latter part of 21 and perhaps may defer it into 22 for the 22-23 budget. Next slide. I mentioned the number of New Yorkers. Again, that percentage is going to go up as wealthy New Yorkers flee New York State for Florida, Arizona, and Texas. And keep in mind that, as you'll hear later, there's a wealth tax that's been added in this budget process for individuals making more than $1 million. So there's a lot of near retirees and retirees that will be establishing new residency. Keep in mind that the federal matching percentage from the federal government is approximately 58%. It started as a 50-25-25 program back in 1965. 50 for the feds, 25 for the states, 25 for the counties. That's been significantly modified now, and of course we're now at 58 or roughly 58% of every dollar comes from the federal government, which is important for you to know as it relates to the audits that we're going to talk about today. While many of you are concerned and always concerned about New York State funding source audits or the OMIG in New York State, we're going to have a lot more activity, if the predictions are correct, in the next 2 to 3 years from the Office of the Inspector General, perhaps the SBA, and other federal regulatory bodies. We are going to apply for an extension to the DSRIP PPS program. That'll be an interesting development since some of the PPSs have already gone through what they consider to be their wind-up phase since the first 5 years ended on March 31 of 20, and many of them were in a run-out mode through March of 21. I still believe that you as providers need to keep in touch with your regional PPSs for purposes of understanding how they intend to distribute any future monies that may be received. We are told that this application has a heavy emphasis on community-based providers, particularly those that are involved with social determinants of health. And then number 8, the workforce crisis. We have never seen the level of vacancies that we are seeing today, particularly in entry-level direct service positions across the entire health and human service sector. And we do believe that the $15 minimum wage that got discussed at the federal level and has already been implemented in the New York City metro area, that upward pressure will create inflation and salary compression with respect to your ability to recruit and retain on a going forward basis. And then the final comments, the qualified candidates, I just mentioned this, are going to be less and less, we believe, as we go forward, unless President Biden puts something in place that allows a significant amount of immigration into New York and the other states where most outside individuals want to move. Immigration could be the solution to our workforce crisis. And many of our clients that work on immigrant refugee assistance programs are anticipating that there will be a significant influx of immigrants that may be qualified for those entry-level positions. And then finally, you are in many cases in a position of feeling comfortable with respect to the amount of stimulus funds that you have received, but we want to be sure that you understand that as you go forward, and as you're going to hear from Jeff, there are going to be situations where maybe a year from now, maybe 3 months from now, maybe 2 years from now, there can be clawbacks and recoupments and double dipping allegations that may be made. And it's very frustrating from a management perspective. The last year has been the most difficult year in my career for management of any nonprofit organization. But that uncertainty and that lack of clarification continues as to whether or not the monies you've received you're going to be able to keep, or somebody's going to come in and audit and try to take them back. And that final comment down at the bottom, I do believe that the administrative cost percentages that are going to be expected on a going forward basis, based on what we've been hearing, are driving down from 15% that's in the Executive Order 38 and moving down towards 12 and probably towards 10, which will result in perhaps even more activities relative to mergers and shared services and outsourcing of certain functions. This next slide is particularly of interest. Even if you don't do CDPAP or CDPAS, I want you to know that I don't know if I'd call it nuclear, but there was a bomb left last month by the Department of Health when they reduced the number of organizations that were eligible to provide CDPAP and CDPAS services from 322 to 68. If you believe the number of 125,000, that means the 68, if they don't subcontract with those other existing providers, will be ramping up to approximately 1,800 to 2,000 individuals being served. And what's also clear is they want at least 5 counties, in some cases 15 or more counties, covered by one of those 68. If you look at it, you would think that since there's 62 counties in New York, there'd be 1 in each county. I don't believe that's the case. There are a number, obviously, in the New York City metro area. So this is, to me, the fair warning from the Department of Health, the Department of Budget, and other things that we're hearing from the various commissioners at the state of New York. Nothing new. We've been hearing it for the better part of 10 to 15 years. The rules of engagement now have changed, and contracting with the state of New York is not going to necessarily be an automatic in the future, and there may be criteria put forth similar to CDPAP and CDPAS that may affect OPW, OMH, OCFS, OASIS providers, etc. I do believe that that's a very important item to be discussing with your board leadership and your senior management team. We have polling question number 1, and I have appointed Mike Vollmer, I believe. Is that correct? Mike Vollmer is going to act as Jimmy Fallon today, so if I refer to him as Jimmy Fallon, you'll know it's his 3 hours in the sun. And so Mike, ask that question and I'll continue.
The poll is open already, but the question is, who won the NCAA men's basketball tournament? A, Gonzaga, B, Baylor, you really don't care, or no?
Okay, can we go to the next slide?
Certainly, yes.
Make sure if you want CPE, again, we didn't say this earlier, but we want to make sure that you understand that this is for CPAs to confirm. I apologize, I thought I turned this off. I want to make sure that the CPAs answer. I believe there's 10 or 12 polling questions, and you want to make sure you answer all of them. This slide is very busy. Just be aware that these are the links to the various sources that we believe are appropriate for purposes of digging a little bit deeper into your budget analysis and how those budget issues may impact upon you. Next one. John, do you want to take some of these, or how do you want to proceed?
You're going good. If there's questions or specifics,
okay.
I can help.
All right. So on next slide, budget expenditures of $212 billion, up from 193. We talked about the Medicaid level. I believe the fourth bullet is very important here. The spending constraints are going to continue to be necessary, although we get a reprieve in this budget because of federal stimulus. With the 1% Medicaid across the board cut that was proposed for July 1, it did not reverse last year's 1.5% across the board reduction. The third bullet from the bottom, the Medicaid trend factor for fee-for-service Medicaid will be frozen through March of 23. That's not what we want to hear. If we are in fact going to see inflation coming as a result of this $6 to $8 trillion coming into the economy. Next slide. The Section 1115 waiver, I mentioned that earlier. That will be a very interesting process. There's a lot of optimism at the state level that the PPS initiative will be extended for a period of 3 years. No dollar amounts have been associated with that at this point, but it is helpful for you to know that in addition to the stimulus already initiated, there may be a significant amount of that 30 to 50 billion that's already been allocated to New York may be allocated to continuation of the PPS program. So that really covers the first three bullets. And obviously, I think I said this last month, I'll say it again. Most people that are futurists or in the healthcare sector believe that the pandemic accelerated telehealth utilization by a period of 10 years. So telehealth parity, et cetera, is far, far different today than where we were in March of last year. And then the last couple of slides for those of you that are interested in VAP for distressed organizations, particularly in the nursing home arena. The VAP applications will be limited, but will still hopefully be available and hopefully be expanded as a result of the 30 to 50 billion that is yet to be allocated. All right, 1% COLA, human service, I should say human service cost of living adjustment, not SOT of living. HCBS, aid to localities bill, you see the funding there, 1.63 billion in federal funds to support HCBS through the American Rescue Act, and that is part of that 23.9 billion that I referred to earlier. And then you've got additional dollars being allocated for OASIS, OMH, and specifically for OPWDD. The fourth bullet here, through 6/30 of 24, the ability for OMH and OPW facility directors to serve as rep payees for resident care and treatment. This avoids revenue loss in a proposal of approximately $7 million for OMH and $63 million for OPW. Rejects the combination of OMH and OASIS into an Office of Behavioral Health. Again, whether or not that's going to happen without legislative approval, it's constitutionally supposed to require legislative approval, but we have seen things done by executive order by the governor that could still be an issue. Authorization of crisis stabilization centers for both OMH and OASIS. And then, as I mentioned earlier, the fiscal intermediary reform and impact on the CDPAP and CDPAS providers is going to be significant. Next slide. Fair pay for home care, the proposal was rejected to require for home care aides to be paid no less than 112% of the applicable minimum wage. Again, pressure on the salary side is going to continue regardless of whether it's in the budget or not in the budget. For the FQs in the hospitals, the 340B pricing program provided a 2-year delay in implementing the carve-out that was going to be somewhat devastating to those participating in this program. So you've got until 2023 before we're going to see any major changes in that area. I've already mentioned telehealth, but I think it's important for providers who are not, and this is another pressure on smaller providers, the ability to afford telehealth technology and equipment is another thing that's driving smaller providers to affiliate with larger providers, because keeping up with technology expectations is going to continue to be more and more difficult as we go forward. And then there's $500 million that's in the budget for health homes. And then I believe the final slide on the budget provisions. I wanted to mention where we were with respect to managed care, long-term care, and the senior service proposals. We'll talk more specifically about OPWDD later when Terry is presenting. But there was a retroactive reduction. Many of you probably heard about this from your insurers. Retroactive to April 1 of 2020 due to the decline in utilization for March, April, May, June in hospital and physician services. There is no projected reduction for April 1 of 2021, but that doesn't mean that the Department of Health and the Insurance Department, they'll be looking very closely at the surpluses generated by the medical insurance companies, which had to be submitted by the end of February, maybe the end of March. So we'll be hearing more about the profits of insurance companies from 2020, which in some cases are said to be absolutely enormous and beyond what anybody could have possibly anticipated due to the decreased utilization in services. There's several provisions here with respect to the direct care spending ratios for nursing homes. Nursing homes spending 70% of their revenue on direct resident care. And again, this goes back to that comment I made about administrative costs. So if you start thinking about direct resident care of 70%, that leaves 30% for essentially all other non-direct services. And in that 30%, you have to come up with the 10 to 12% that are purely administrative. So the pressure continues and will be continuing as we go forward on administrative cost percentage. We now have a second regulation. Nursing home profits are capped at 5%. And that's, again, a way to have the state be able to recoup dollars for funding future increases expected in the Medicaid program. And the last provision, there are a number of provisions related to provider funding, which we strongly suggest that you go to either your provider association or the links that we provided on one of those earlier slides. And we will now go to polling question number 2.
I will open it in just a second. The question is, who won the NCAA Women's Basketball Championship?
Watch this.
And what are the choices?
We have Stanford, UConn, Arizona, or Baylor.
All right, while you're answering that question that Mike just posed, on the next questions slide, we say we want you to submit questions to the chat function for all panelists. This is a personal opinion from Jerry Archibald, not necessarily going to be shared by everybody in the firm, but example of a question that people should be asking themselves. When you put 6 to 8 trillion into the economy, which is 30% of GDP, what's going to happen, particularly if the supply side is impacted? Well, lumber went up 100% from last year to this year, for many reasons, but not the least of which where it was the wildfire season out west. And I was talking to an attorney earlier this week that said In October, he got a 4x8 sheet of plywood for $8.50. Went back this week, the same sheet of plywood was $30. So as you're putting your budgets together for 2021, or as you're revising your budgets based upon the budget that has been passed, please pay attention. Please pay attention to something. I'll pay attention to my phone. Sorry about that. We expect that something that we haven't necessarily had to work with for maybe about 10 years, at least anything more than 2 to 3%, is now going to be much more important from the standpoint of budgetary projections. And with that, having gone over my time limit, as I always do, I will turn it over to our subject matter expert, Jeff Paley. And Jeff has been a tremendous resource, not only for the firm, but for many, many of our clients and non-clients throughout this last 13 months. Jeff.
Thank you very much, Arch, and thanks everybody. Good morning. Happy to be here to chat through some of this stuff. If we go to the next slide there, Mike, there's a lot of changes. This next little section we're going to go through is focused on the key changes from the last 45 to 60 days. A lot of that has to do with the American Rescue Plan Act, which of course passed a few weeks ago. We're seeing a lot of impact from this on the nonprofit sector. There was a lot of advocacy in advance. Senator Schumer was listening to that, and a lot of that actually is reflected in the law. One of the things we're seeing, and it's in red here on the slide, is there's a lot of individuals who are approaching us with an idea of something that they're going to take advantage of from this, from these changes. And very often they've found this idea somewhere on the internet. This may be sort of a basic caution, but there's a lot of stuff on the internet that may not necessarily apply to you. And in fact, there's a lot of things on the internet that are absolutely correct. However, it's not correct for your organization or your situation. So we're having a lot of conversations where we're sort of walking people back from a position that they're trying to take because it doesn't apply to them. And it's really a sign of the details and complexity on some of these programs. So if there's an overriding caution, as you're poking around, Googling for the answer that you're looking for, understanding that it's really relevant to your situation is a key element of this, and it's becoming a very common point of discussion as we're going through. The answer to that is to seek guidance from somebody who's seeing this. Your team and your organization is highly qualified and capable, but they're only seeing one organization's situation. Professional, the team here on this meeting, as well as a lot of the professionals in our firm, and there's other providers too in the legal profession, et cetera, have seen dozens and dozens, if not hundreds, of different situations and can sort of advise from a broader perspective, and that's really important. Let's go to the next slide. So the Rescue Plan Act passed, and this pie chart is interesting. When you're talking about $1.9 trillion, the slices of the pie are quite large, even when they look quite small. So the green one there, it's only $125 billion, but it's the smallest slice of the pie. You'll see here that there's the other boxes, or other triangles, $455 billion, just because we didn't want to break it down into all the really smaller pieces. But there's a lot of money and a lot of liquidity, frankly, sloshing around from this bill that will filter down, and a lot of that, frankly, is going to be available potentially to nonprofit providers. The key thing here in the bullets is $23.8 billion directly to the state and local governments, and we're going to talk about that a little bit more, but that is a lot of money coming into New York State. We go to the next slide. So what we decided to do from a time perspective is we're not going to go through all the elements, the technical elements of the various things that are in the bill or the law. Instead, we're going to break down basically the top 10 list of the things that our organizations that we're working with are talking about, struggling with, and we're looking at this really from three perspectives. We're looking at the opportunity that these items present, we're looking at the challenges that these items present, and we're looking at the risks that these items entail. So for each of these, we're going to look at the opportunities, the challenges, and the risks. These are the most common things that nonprofits are dealing with right now related to this. So let's go to the next slide for number one. And this is aid to state and local governments. We just talked about $23.8 billion coming to New York. One of the things that's a little bit different in this round is that almost half that money is supposed to flow through counties. And counties have a different level of discretion as to how these funds are used, how they're dispersed within their county. What we see with this is, anecdotally, as we talk to folks at the various counties, and particularly in New York State, they are not sure what they're going to do with these funds, and they're still formulating plans. And again, it varies from county to county, but this presents an opportunity and a challenge to providers looking at and thinking about the counties that you operate in, the folks you know at those county governments who may have influence over how these funds are dispersed, and perhaps even talking to them in various stages of how they're deciding how they're going to disperse these funds or use these funds. Like I said, counties are in different stages of decision making around this and how these funds are going to be dispersed. If you can get in front of a contact at the county that you operate in, and you can talk to that person and position yourself in a way that would be advantageous related to the dispersal of these funds, the time is now. And there is an opportunity to do this. It's perfectly acceptable to have a conversation with your county representatives about what their plans are for this. And if they don't have any plans, it's perfectly acceptable to give them some ideas. So I'm not suggesting anything untoward here. I'm just saying having a conversation and understanding the county plans for the counties that you operate in is worthwhile. This may not be, for many providers, this may not be a focus area, county relationships like this, but it's something worth thinking about in the context of this new pool of money that's coming in to New York State.
Jeff, I would also add, that our government and compliance group in the firm works with more than 30 counties of the 59 or 60 counties, 61 that are in the state. So we also have relationships that might be beneficial for our clients to take advantage of.
Absolutely. Thank you, Arch. On the next one, let's go to number 2. The Paycheck Protection Program, we've been talking about this now for 13 months, or almost 13 months. There were some significant changes in the latest law. The biggest one, or the biggest two actually, one of them was that all types of 501c3 organizations are now eligible for the PPP program, except for 501c4s. This opened it up to a lot of organizations who had previously been excluded from this program. The other one, which was, in terms of dollars, much more significant, was that the eligibility is now allowed for nonprofits based on your employee count per physical location. So previously, if you had over 500 employees, you were generally excluded from the PPP program, and of course, there's a lot of details and there were exceptions to that, but that was the general rule. Now, if you have fewer than 500 employees per physical location, you're eligible. This has allowed a fairly sizable list of larger nonprofits to get PPP loans since mid-March. It has had its challenges because the forms and process that lenders have set up for the PPP program did not necessarily accommodate this change on a short-term notice, but many larger nonprofits have now gotten PPP loans. And that's who were previously closed out of the program. That's been a fantastic benefit to many of these providers. What also happened since then is that the PPP program was extended to May 31. This presents an opportunity and a challenge to think about if you got your first round PPP loan in March and you have to use a forgiveness period of at least 8 weeks. Can you expend those funds in 8 weeks before the end of May and legitimately apply for a second round PPP loan? This is a real possibility, and it's something that if you have not thought about it yet, you should think about it in the context of, can you expend and manage your first round PPP loan if you got it in March of 2021 to legitimately say that you've expended those funds before March 31st and be able to apply for a second round loan, which could be lucrative up to the max of $2 million on the second round. The challenge with that is that there's a lot of lenders have not updated their portal for some of these elements, and so therefore you have to reach out to the lender and actually have a conversation. It's not as easy as simply just going on their website and applying. If we go to the next one, the employee retention credit, the law changed to allow the employee retention credit for all 4 quarters of 2021. Previously, it had ended on June 30th of 2021. The other law change that is most interesting here is that they allow the IRS now 5 years instead of 3 years to go back and audit these returns. There's a sense that the government is concerned about fraud and abuse of this particular program, and there's also the sense that the IRS at some point, when they get out from underneath the mountain of ERC claims that are coming in right now, that they're going to go back and review some of these on some kind of parameters. What this means for you, if you're trying to claim the ERC, is you really have to have solid, clear documentation related to your eligibility for the employer retention credit, and also for the calculations of how much credit you're claiming. Do not do this on the back of an envelope. This should be a real, legitimate, documented process. You're making a tax, this is a tax form, it's the 941, and you're making a tax claim here, and all the potential penalties related to erroneous filings, tax forms apply. So this is going to be a focus area going forward, most likely, of the IRS, and you want to make sure you have your documentation clear. There's a lot of strategies here. We're going to talk about the double dip in just a minute related to allocating your payroll to this versus other funding streams. Go to number 4. Paid leave credits. These were extended through September 30th. This is the sick time leave and extended family medical leave credits. There were some other changes to it, but generally it's the same as it was in 2020. It's just now available through September 30th. Go to number 5. Oh, we have a polling question.
I admit I was not ready for the polling question.
Snuck up on me.
All right. My organization's appetite for additional COVID-related relief dollars is best described as, and I'm not going to read them all because it's a little lengthy.
So while we are answering the question, if we can proceed, I guess we can. Number 5, this Cobra Subsidy. So this is an element of the rescue plan that has not been talked about a lot, but it actually has some specific elements that every employer needs to think about. Cobra, if you're familiar with it, as a review, if you separate service from someone, you have to offer them the opportunity, under most circumstances, to continue their health insurance at their own costs. So the former employee would pay you for the premiums that you are paying to keep them on your health insurance. What this rule changes is says the federal government's going to pay for that, and the former employee does not have to pay for it. So how this is going to be worked is that you would pay for it as part of your paying your health insurance company for this person's health insurance, and get the money back in the form of a tax credit on your 941 at some point in the future. Now the kicker here is that you, generally speaking, Cobra eligibility goes for 18 months from the date they separate from service. You are now supposed to, under this rule, go back and identify everyone who's still eligible who is a former employee. So if you've let anyone separate from service in the last 18 months because of a COVID-related reason, under this rule that's in the rescue plan, you're supposed to go back and identify those people and make them aware that this new opportunity is available and allow them to enroll in Cobra through your company. This is potentially a challenge, because if you did a layoff in April of 2020, do you really know where these people are? Can you reach out to them? Can you find them? But hopefully your HR department is already on top of this, either doing it or getting ready to do it. And if not, you should probably pose that question to them, because it's a requirement. Number 6, unemployment. There's still a lot of questions about this. We go all the way back to March of 2020, the CARES Act. The federal government said that they were going to cover 50% of the cost for nonprofits who are self-insured for unemployment for COVID-related unemployment claims. In January 14th of 2021, New York State, by executive order, indicated that they're going to cover the other 50%, retroactive to March of 2020, which means that if you're self-insured for unemployment, all of the unemployment costs that you would have incurred since March that were COVID-related, you do not have an expense for those. The state and the federal government are going to cover those. This act extended that through September 6th. The reason this is so confusing is that the State Department of Labor is still sending you bills. So you may be sitting there getting a bill right now that says you have to pay for these unemployment costs, when between the federal legislation and the state executive order, you're not actually obligated to pay those bills. This is very confusing. And if you have paid those bills, you are supposed to, and you will receive a credit for those dollars back to your account at the unemployment office, ultimately to be refunded to you. At least that's the plan. So if you have those expenses on your books, there's a strong position to be taken that you can receive those funds back and unbook that expense, if you will. Number 7, the shuttered venue operator grant. I can only shake my head at this one. I put these slides together a few days ago, and the first bullet there, the applications opened yesterday, and I said, assuming everything went according to plan, it did not go according to plan. The website was, if I may summarize, a total disaster, and no one was really able to apply, and by the end of the day, the SBA had actually closed down the website, and they have indicated they're going to try to fix it and open it up at a future date. So if you're in the running for a shuttered venue operator grant, remember this is for live event venues, movie theaters, museums, those types of organizations, and you were trying to get in and apply yesterday. That was not possible because of the website issues, and we don't have a new timeline for that from the SBA yet. Idle loans. The idle loans were kind of overlooked in many circles back in 2020 because the PPP program was much more lucrative with the forgiveness provisions. Idle loans were extended. The dollar amount is extended now to $500,000, and there's criteria based on the size of your organization. And this is a loan that has no forgiveness provisions. It's a 30-year loan that you pay back over 30 years. But if there are organizations who got a first-round PPP loan but are not eligible for a second-round PPP loan for whatever reason, the EIDL program is an option if you are in need of additional financing. Again, not forgivable, but it is a loan with some fairly agreeable terms. The SBA does take a security interest in your assets, so that's something to think about if you have other debt or security interests on your assets, but it's something to look into if you're looking for financing, but you cannot get the second round PPP. The targeted advances, there was a $10,000 advance available from the EIDL program back in the spring of 2020. The money ran out, and there were a lot more people or a lot more organizations who applied for it. The SBA has that list. The latest legislation put more money in that pool, and the SBA does not want you to apply for this. They're going to take the list of people who applied a year ago and basically just start funding these based on your identification as being in a low-income community as first priority. So if that might fit your criteria, you may get $10,000 put in your bank account in the near future from the SBA. So look out for that. On number 9, counting employees, and I can now tell that there's no way anyone's going to read this slide, so I apologize for that. But the reason we talk about counting employees, this is not new, but it is continuing to be a significant challenge and a significant issue as people are thinking about the PPP program as well as the employee retention credit. There's different methodologies for counting, and in general, for eligibility for PPP, whether it's 1 or 2, the counting of your employees is head count. So every person counts as one, whether they're full-time or part-time. When we're talking about forgiveness on PPP 1 and PPP 2, we're talking about full-time equivalents based on a 40-hour work week. So you have an entirely different calculation of counting your people for the forgiveness calculations. And then for the employee retention credit, they want to count full-time people and ignore part-time people. So you're only counting your full-time people, and they define full-time as people who work 130 hours a month or more. So that calculation has to be made in a totally different way. So there's a lot of organizations who have a sense of how many employees they have, and they don't think about 3 totally different calculations of coming up with that number, and try to use a calculation that's for one of these programs and apply it to the other program, and that gets you in trouble. It's really important to understand you have to count people at least 3 different ways to get through these programs effectively. And number 10, and the biggest one, the double dip risk. You have most likely received multiple sources of federal aid related to COVID, and some of them are listed here, some of the potential ones. There's certainly others. But you have to also think about your non-recurring, just regular, if I will, funding sources that are recurring from year to year. And in most of those cases, $1 of expenditure can only be applied to support one of those funding sources. On this list, there's 12 different things. There's certainly many more things that you could come up with in terms of funding sources that might be applicable over the last 12 months. At least 11 of these items, you could apply $1 of payroll costs to, in support of. So the danger here is that you might apply either purposely or because there's an error or because you're not paying attention, you could apply $1 of payroll to multiple things that could get you in trouble later with one or both of those funders for claiming that $1 of expense against multiple funding streams. So if we go to the next slide, it's really important, we think it's critical from a risk standpoint, that you have a strategy around the double dip risk. Most organizations are looking at this in the context of I have my PPP, which covers this time period, and I want to get forgiveness on that by applying expenses to it. I want to go for the employee retention credit. I know those time periods overlap, so I'm trying to understand which dollars I can put in which. But then you have things like the provider relief funds, which we're going to talk about shortly, that you can also apply expenses to. You have things like other grants. I talked with an organization earlier this morning who has a grant from a private foundation that's specifically to cover specific expenses, and they want to know, can they also apply those expenses to these other federal programs, and it's very questionable whether you can. So having a strategy around this, because there's a lot of risk here. You could end up booking income for all these things, and then over the next, like Art said, 3 to 5 years, have one or more of these funders come back to you and say, you didn't have enough expenses to support all these, and I want my money back. That is a very real risk. Whether you call that a clawback, a double dip, or whatever you want to call it, those things are real, those dangers are real, and those risks are real. What does this mean? Well, this means if you're showing a very large surplus, you really have to think very carefully, can I really support that I earned all these funds and that I supported them all with expenses? Or should I record a liability for the potential that somebody might come back and want some of this money back based on how I've managed these various fund streams? If you haven't had that conversation internally, you could be missing a risk, and that's potentially material. It's a big deal. So understanding this and understanding that you've documented this conversation is really important in terms of the go-forward risk. Like for the ERC, the time period which the funder could come back and audit this is 5 years. So, I mean, you could be looking at doing things today that could come back and become a problem 4 to 5 years from now. Understanding those risks today and recording them in a way that makes sense based on the intermingling of all these different programs is very important, and it's quite involved. You really have to dedicate the time to think through the implications of these things. If you're not doing that in your organization, there's a chance that your risk is there and you're not catching it. So that's our top 10 list in the interest of our time here. Go ahead, Ryan. Polling question.
So next polling question. My organization's strategy around double dip risk is best described as thoroughly considered and documented, risks appropriately managed, thought about it but have not crunched numbers or quantified potential risks, hoping that the various funders come to their senses and just let us keep all of the money, which I think we all want, or D, not worry about it. The poll is open.
Our next presenter, who is also a subject matter expert, thank you very much, Jeff, that was a great presentation, is Margaret Lally. I believe many of you have heard from Margaret in the past, either directly or through one of our webinars. And Margaret is going to give us the update on the Provider Relief Fund, which has also been a bit of a roller coaster ride over the course of the last 13 months. Margaret?
Great. So before I dive into the Provider Relief Fund, I did want to talk about a couple timely issues related to Medicare. So the Senate did pass an extension of the suspension of the 2% Medicare sequester. That's the 2% across the board cut to your Medicare payments that was instituted in 2013. The House also passed a similar bill, but of course their language was a little bit different. So the House is going to have to pass the Senate bill in order for that suspension to take effect. However, they are on recess until April 13th. So in order to avoid reprocessing a lot of claims, CMS has instructed the MACs to hold claims for services provided on or after April 1st. until the House passes that suspension. So if you're not receiving your Medicare payments like you think you should, this would be why. And I do think that, you know, if you're having cash flow issues, definitely reach out to your MAC and they may be able to help you out with that. Another Medicare program that is top of mind right now on the next slide is the Medicare Accelerated Payment Program. So about 1 year ago, you were able to request an advance on your Medicare payments. And in October, they changed the repayment terms and they're just kind of coming due now. So, you know, you had some time to apply, but you could have applied as early as March 30th. So if you did in fact do that, then your first recoupments are going to start 1 year after, so March 30th of 2021. And Medicare is going to take back this money by first recouping 25% of your claims for the first 11 months, and then 50% for the next 6 months after that. And then if you still have a remaining balance, you're going to receive a demand letter from the MAC, and you're going to have to repay that balance within 30 days, or they're going to start to impose 4% interest. So again, you know, this pushes this out to at the earliest October 2022. And if you are still having cash flow issues, again, your MACs are pretty responsive to that. A lot of times they'll extend repayment terms out as much as 3 to 5 years. So where are we with the HHS Provider Relief Fund? So honestly, there hasn't been a lot of movement on this since our last webinar. Just a lot of ongoing uncertainty. So we were all really excited to see the portal open on January 15th, and it was scheduled to close on February 15th. And that date came and went. They did open the portal on January 15th. However, it's only open for registration. And that's the same message has been up since January 15th. There's no anticipated date that it's going to open. And, you know, in fact, we're getting close to the time frame when the money, you know, the available use of it is ending on June 30th. The final portal was supposed to be due July 31st. So, you know, I'm not sure if they're going to end up combining this timeline. There's some thought that perhaps you'll be able to have further time to spend the money, perhaps to the end of 2021. We've seen a lot of these other programs get extended out, and since, you know, the pandemic doesn't seem to be ending as quickly as we had all hoped last year, and, you know, the rollout of the vaccine is ongoing. So I wouldn't be surprised if they extend out the time frame on that. Still, obviously, no word yet. I think a lot of the delay has to do with the change in administration. I know the Biden administration is trying to get people appointed and put in place in leadership positions. So, you know, I'm sure they're taking a look at all these roles and seeing if they want to change their approach. One of the biggest items that's really uncertain at this point is how PPP proceeds will be treated in the lost revenue calculation. So, and this is, you know, a huge material impact for a lot of our clients. It could take you from having substantial lost revenue to no lost revenue at all, depending on whether they include those funds. So, you know, initially there were FAQs saying that you did not have to include grant funds in your lost revenue. Then they amended that and said that you do have to include grant funds, but only if they're used to fund patient care. So, you know, given that PPP is used for payroll and a lot of your, you know, capital items, you know, it would seem that that would be funding patient care. Then in late December, early January, there was an FAQ that explicitly said you absolutely have to include PPP in your lost revenue, but that FAQ was subsequently deleted. So I don't know, I've never seen an FAQ deleted before. I don't know if that means that they're rethinking their approach and that maybe they're going to exclude it. But again, you know, whether you're figuring out how you want to record revenue, whether you're working on your reporting or your single audit, this is going to be a huge item depending on which way they end up falling on this. And then the other big open item is what I'm calling phase 4 funding. So the COVID relief package that was passed in late December last year, I think a lot of people identify it as the one with the $600 checks for everybody. Congress did appropriate additional funds for a phase 4 of the Provider Relief Fund, and it would be based on your financial losses for the second half of 2020 as well as the first quarter of 2021. So unfortunately, since that legislation was passed, we really, again, haven't heard anything on when this application is going to be available. I'm kind of wondering now that since the reporting has been delayed, perhaps they'll use the reporting portal as the application, because if you're going to be reporting on, your quarterly 2020 numbers, and potentially if the portal is delayed further, I guess you could probably have the information to report on the first quarter of 2021. So it'll be interesting to see how they decide to do it. If they do combine it, I guess it's a little bit less work on everyone's part, but phase 4 money is coming. We just don't know when. So on the next slide, I've got some action items. There hasn't been a lot of movement, but there's still some stuff that you can be working on. So you do want to go onto the portal and establish an account. They say it takes about 20 minutes. I've had clients that said it was literally like a 3-5 minute process. So, but at least it'll get you set up. It provides an email address for HHS so that they can send you an email once that portal is open. Another thing you're going to want to do is revisit your lost revenue calculations. The COVID relief bill in December allowed you to use 3 different methods to calculate it. You can either use year-over-year comparison, so 2019 versus 2020. You can also use a budget to actual comparison if you had a budget approved in place before the CARES Act was originally passed in March of 2020. And then there's a third method that is this, quote, any reasonable method. So if you have specific items that make one of the other 2 methods not really work for your facility, you can use this other method. It is subject to greater scrutiny and potential audit, but as long as you have it very well documented how you're doing it, that could be a good way to go. The other thing you're going to want to look at is if you're moving money around between subsidiaries and parents, you want to understand how that works and what the impact is on reporting. So another thing that December bill did was allow you to move targeted funds between entities. But the original recipient of that fund is who is going to have to report on it. So the rules are kind of different for general versus targeted, and you're going to want to look at the FAQ to see how it affects your particular situation. Again, you're going to want to develop reporting procedures for lost revenue and increased expense. And I would encourage you to, see how that lost revenue calculation comes out, both with the PPP funds included and without the PPP funds, because again, we don't know which way they're going to fall on that. And also review audit and compliance requirements. So if you're going to be subject to single audit, you definitely want to review that. There is a lot of information on the website about reporting and FAQs, even though it's not final. So you do want to review and make sure that you've got all your I's dotted and your T's crossed. So now I'm going to talk about a few frequently asked questions that we've been getting lately from clients. Like I said, there's not a ton new. There's been a couple updates to FAQ since the Biden administration took over, but really it was nothing groundbreaking. It was just adding a little bit of language here and there. So nothing really new. But one of the big ones we get is, can the full purchase price of inventory and capital equipment be used to offset provider relief funds, or is it limited to the depreciation expense during the reporting period? And I'm happy to say that you can use the full purchase price as long as it's related to coronavirus. So, if you have funds that you're worried that you're going to have to pay back, this can be a great place to look at, an investment in the long-term future of your provider, because you can invest in things like telemedicine, for example. Arch talked about how the COVID pandemic has really pushed telemedicine up by about 10 years. And this offers you an opportunity that's clearly, you can clearly tie it to COVID, but you can make a really great upgrade for your future as well. The next question we have is, what are incremental expenses based on? What if my total expenses decreased due to lower volumes, but I did have COVID-related expenses? And you do not need to look at your change in total expenses. So, if you flexed your staff down, if you, pulled back on a lot of expenses in anticipation of the, financial hardship that was coming, but you still had incremental COVID expenses, you can include all of those incremental expenses. So even, for example, let's say you laid off some people and so your total salaries went down, but for the employees that you still had working, you gave them hero pay bonus. You can include that hero pay bonus even though your total salaries decreased. Next question, when calculating lost revenue, what if your budget year is not the same as the calendar year? And this is one of those things that we wish they would change, but right now they are compelling you to use calendar year basis. So if your budget is not on a calendar basis, you really can't use that budget to actual. You could use the hybrid method and say use 6 months of your budget and then the other reasonable method for the other 6 months. It's potential that you could use a newer budget, but I think you would have to really document well the fact of how that budget was created. They want to make sure that you're not inflating your budget just to increase your lost revenue. So you would really need to make sure that that the fact that you didn't do that is very well documented. And again, anytime you use that other reasonable methodology, you're going to face greater scrutiny, potential audit from HRSA. Another big one is, can corporate overhead be allocated to entities and included in COVID-19 expenses? And what about exempt personnel salaries? So yes, you can allocate overhead. It needs to be some sort of situation where you were doing that before the pandemic. So if you have some sort of home office that's allocating expenses out, as long as you were doing that before the pandemic, you can continue to use that afterwards. So if you have corporate level COVID related expenses, you can allocate those out to your various subsidiaries. One very new FAQ that did come out was related to these exempt personnel salaries. So let's say you have a CFO that's spending half of their time on COVID task force meetings and other COVID related work. Unfortunately, they are salaried, so there is no incremental cost. And they explicitly say that you can't include opportunity costs, so the work that they could have been doing but they're not doing, that doesn't count for PRF. So unfortunately, if you do have salaried employees, unless they're getting some sort of bonus or some sort of additional funds because of COVID that they wouldn't have gotten normally, you can't include those expenses. The other one example that is includable is if you hired somebody specifically to handle COVID issues, then you could include that. So another question is, if lost revenue is more than what you got for provider relief funds, do you still have to identify and report your expenses? So a lot of people, I get the desire to do this because the PRF funds are different from a lot of the other programs in that you can use lost revenue. So using the lost revenue really kind of helps with that double dip issue. But unfortunately, the rules do state that you have to identify and report all of your healthcare related expenses attributable to coronavirus that are not reimbursed by another source first. And then you have to report lost revenues. Now, you are going to have to report lost revenues either way. So they're going to ask for both on the reporting portal. But yes, you do have to go through that exercise of looking at your expenses. And I would say that, one reason that you really should do that is because since we don't know how this phase 4 is going to be allocated, you don't want to underreport on the portal and then, not get money that you could have gotten if you did report on everything. So, really important to really dig deep and look in at invoices and figure out what kind of expenses you have that you can report, as well as that lost revenue. And then, shout out to the accounting industry here. Can PRF funds be used to cover the expense of a single audit? And yes, they can. So, a lot of people worried about the single audit. It's more fees than you're used to. And, a lot of you probably haven't gone through a single audit before. But, the only reason you're going through this single audit is because you got PRF funds. And because that was from coronavirus, you can absolutely use them to pay for your single audit fees. So now we've got another polling question.
Franklin Delano holds the American record for a standing high jump kick prior to World War II. True, false, I don't know. You're going to open it in a second when this little window disappears. There you go. Thank you, Mark.
All right, so kind of to wrap up, the American Rescue Plan did have some items related to the Provider Relief Fund, and a lot of it is around oversight. So $5 million extra was allocated to the HHS Office of Inspector General, and $40 million for a pandemic response accountability committee that kind of oversees all of the COVID-related funding. And the last bullet point here, we did have our first provider relief fund indictment. There was a provider in Michigan, home health care operator, who actually stopped operations probably around January or February, but then they received money in that initial automatic payment that went out to providers with Medicare utilization. And so they didn't return the funds, and it was investigated by the HHS OIG as well as the FBI, and she was charged with embezzlement from the government. So, just a warning that, we've been getting all this money, but, as everybody's been saying here, now that this is sort of winding down, they are going to be looking at, ensuring that there's not fraud, waste, and abuse going on. And then there was additional funds in this American Rescue Plan. There was about $8.5 billion more for rural providers. There was a pilot program through the Department of Agriculture for medical surge, vaccine distribution, and telehealth in rural and low-income areas. And then they've also got this $200 million for infection control and vaccines in skilled nursing facilities. So with that, I think that's all of the updates that we have on the HHS Provider Relief Fund. If you have questions, feel free to put them in the chat, submitted to all panelists, and we will try to get to those.
Thank you very much, Margaret. What we're going to do is we're going to move the presentation for John Miller till after lunch, because we've got about 5 or 6 minutes here before we want to break. I want to ask Jeff Paley one of the questions we've received, and then Mike Bomer, Jimmy Fallon has some others. Jeff, government regulators appear intent on fully auditing the PPP loans in excess of $2 million. What is your opinion regarding whether individual providers with large PPP loans should engage their independent auditors to perform a pre-audit of their supporting documentation maintained for loan forgiveness purposes?
That's a great question. I'm going to have to give you a two-part answer. The first one is anecdotal, based on the reviews of these applications that we've already been engaged to do and we've already been doing. I will tell you that at least 90% of them, we find something that needs to be fixed in the calculations or in the documentation or something else. And sometimes those are little things and sometimes they're bigger things. But with a 90% hit rate, that's indicative that there's a reason to have a second set of eyes on this thing. The other thing is, so part two of the answer is, this is a risk management decision in the context of, yes, there's an expenditure related to having an auditor or somebody review this thing before you submit it, but is it worth taking the chance to save the small amount of fee that you would pay for this kind of a review to put the entire loan amount at risk because you didn't do something right on the application? And for many of the, if we're talking about the loans over $2 million, that's a sizable risk to take on, that when the SBA looks at this thing, they're going to find a problem and it's going to cause issues for you. I'll also add that the SBA has not approved any forgiveness decisions for loans over $2 million since the change in administration. A lot of those are past the 90 days that the SBA is supposed to have to make these approvals. So if you have applied for forgiveness on a loan over $2 million, you're waiting still, and everyone else is also waiting for those loans. Because the SBA believes there's a lot of fraud and a lot of risks associated with these, and they're trying to figure out still how to manage that risk in their reviews. So they're taking stringent risks. I believe it's worthwhile to have a second set of eyes on this thing from somebody who's looked at a lot of them. Your team internally has done the forms. They've only looked at that one. They may not have the perspective on all the different risk elements.
Jeff,
I'm sorry, go ahead.
thank you. Jeff, I have a quick question on unemployment. Is the unemployment coverage, I'll call it, by the feds and state really just related to COVID or to all unemployment claims?
It's technically related to COVID from the start of the COVID disruption on March 12th. However, it's very difficult to specifically say that if you laid someone off, that it was not related to COVID. It's possible that happened, but the state is going to be very challenged to just differentiate between a layoff that happened because of COVID versus not because of COVID. So yes, technically, the coverage for that is for COVID-related unemployment claims, but comes down to your documentation. If you were audited, do you have documentation that this separation from service was related to COVID? Very difficult to differentiate during this time period when we're in the state of emergency and everything.
And there's also a rampant amount of fraud in this program. So that was one of the comments. Somebody said they didn't lay anyone off, yet got billed for unemployment and are trying to fight those claims. And that's not an unusual situation for anyone to be in.
And by the way, just because you're not obligated to pay the bills, you still are obligated to review those reports that you get from the Department of Labor about your former employees who are placing claims and tell them if those claims are not valid. So don't ignore that process. You still have to do that, and if you don't do it, you can get in trouble with the DOL.
Margaret, a couple questions for you. First one I think is a quick, easy one. You mentioned MAC. What is the MACD MAC that you mentioned?
So that stands for Medicare Administrative Contractor. For most providers around here, it would be National Government Services or NYS, but they're the intermediary that would deal with your claims, your cost reports, that kind of thing for Medicare.
Thank you. Follow-up question, not really related, but when do you expect the audits of the provider relief funds to be conducted? And do you know which government regulator will be conducting those audits?
So I think a lot of the larger amounts, they're probably going to rely on the single audit to take care of those. We do know that HRSA can conduct audits, especially if you're transferring some of those targeted funds, some of the other kind of red flag scenarios that they want to take a little better look at. Again, if you use that any other reasonable method of lost revenue calculation, you may face greater scrutiny, and that would be HRSA. As far as other entities, I think HRSA is the only one that they've explicitly talked about. But you can see from that indictment that, the HHS, OIG, as well as the FBI, everybody is concerned about fraud and abuse. And so, there's going to be scrutiny from all of those parties.
Thank you.
I've got one last question here for Jeff before we break for lunch. If you were the CEO or CFO of a large nonprofit service provider that has received significant amounts of federal stimulus, what would you consider to be your top 3 priorities for purpose of protecting and retaining the stimulus dollars you've received?
The top 3 priorities, I would suggest that understanding that your accounting and financial reporting team understands these rules in some way, shape, or form. A sign that they don't, and I know I'm generalizing here, if you're showing a giant surplus that is not explainable other than, well, we got all this federal money, that's probably a problem, or at least it's something you should poke at a little bit, because it's possible that if you're just recognizing all the revenue and not thinking about whether some of it should be a liability, you're missing some of the elements of some of these programs. The other one is making sure the documentation of your eligibility is important on this, especially with the PPP. There's a lot of people, and at the CEO level, if you got a PPP loan and you're just saying, well, we must have been okay to get it because the bank said yes, that is not going to hold up upon audit. The law specifically gives the lenders the ability to rely 100% on the applicant's representations. And so if you're saying you're eligible, the bank is allowed to say, well, they said they're eligible, so I'm going to approve it. So if it comes down that you weren't eligible, and we're seeing a lot of these situations, unfortunately, where an organization really wasn't eligible, but they got a PPP loan anyway. Now they're going back to say, how do I document my way through this? Those kind of, the documentation of your eligibility, I'm talking about PPP as an example, but it would count for any of these, is really important. And then number 3, in terms of priorities, making sure that your governance group, your board, understands the risks and the opportunities from these programs. You do not want, if I was the CEO, I would not want to have the risk that 18 months or 3 years from now, some funder is going to come back and want a giant amount of money paid back to them because I didn't do this right now. I would want my board, and I think every organization's board should understand, even if you did everything right and crossed all the T's and dotted all the I's, there's risks associated with the intermingling and the intertwinedness of these funding programs. You don't want that to be a surprise if something comes up later that you're getting audited or that there's a claim by a funder that you need to pay money back. Make sure your board's informed about these things.
To the last point that Jeff made, I mentioned earlier, there's a Business Journal article that I wrote that'll be attached to the slide deck that you'll be able to access on Monday. And one of the specific topics in there is communications with your board and how best to communicate the risk. We can see a lot of Monday morning quarterbacking occurring in 2021, 22, and 23. And keep in mind about the confusion that we've talked about already today and more confusion yet to come. It's 12:22. Welcome back, everybody. It's 12:52. I'm going to start with a question for Margaret Lally that came in on the chat. Margaret, could you describe how the 5% cap on nursing home surplus is supposed to be calculated?
Yes, so that 5% limitation on profit or net income is based on your operating revenues as reported on the cost report, less your operating and non-operating expenses. And the 5% is of the expenses and non-operating expenses. And the one thing that we're not sure about with the language of the bill is if you have a direct care penalty or a resident-facing wages penalty, the language isn't really clear on whether they're going to assess that profit penalty as well as, or if it's an either or type of a situation. So we're waiting for further guidance on that.
And my immediate reaction to that is, where do you include investment income to the extent a nursing home has investment income? And that has to be something carefully considered on the cost report. So I announced earlier that Ethan Kahn joined us on April 1st, coming over from Azars, and we're thrilled to have him. I'd like to have Ethan just spend a minute giving you a little bit of his background. And certainly anybody that's down in the lower Hudson Valley or the city or tri-state area, this is a tremendous addition to our depth of experience in that region. Ethan.
Thank you, Jerry. It's a real pleasure to be here today. It's a pleasure to be a part of this firm. What I've learned over the recent couple of days was that I'm part of sort of a specialist committee where the firm has individuals that really practice in every area that I could think of in the not-for-profit and healthcare arena. The background that I'm coming with is about 23 years in the not-for-profit sector, doing auditing, tax, and after having been an outsourced CFO, COO, executive director, and working on with probably hundreds of organizations on audits and consulting, it all kind of comes together in trying to deliver the best possible product and being proactive with organizations. And I'm just thrilled to be part of the Bonadio group. The more I talk and the more I listen, the more I realize that they're really the premier that's out there in this industry. So it's a real privilege for me to be a part of this group, and I'm looking forward to contributing throughout. Thank you, Barry.
Thank you. Thank you very much, Ethan. And just so everybody knows, I did not pay Ethan any extra money for him to say what he just said. So we'll turn it over to John Miller, and John will be reviewing the American Jobs Plan. We're not going to spend a lot of time on this, but because it is another $2 trillion, I think it's important for us to at least bring you up to date as to where we are today. John.
All right, so thank you. You can see from this disclaimer, I put together these slides on April 6th. This American Jobs Plan is subject to change a lot. So what I say today is probably going to change when Congress comes back from recess on the 14th. If we go to the next slide. So what is this? On March 31st, President Joe Biden released the details on the American Jobs Plan. Some are referring to this as his infrastructure plan. It provides funding for infrastructure, clean energy, innovation and R&D, manufacturing and workplace support, and the caregiving economy. This is a $2.3 trillion plan. So that's, again, trillion. That's in addition to the $1.9 trillion of the American Rescue Plan. So to pay for this, they say we're going to need revenue increases, and we all know that is code word for tax increases. We'll cover that a little bit today as well. So when we go to the next slide, the theory of this is Jeff talked about earlier, parts of the American Rescue Plan. These two plans are going to work in connection with each other. The American Rescue Plan is meant to be short-term and provide relief related to the pandemic, whereas the American Jobs Plan is expected to be long-term. So the $2 trillion, $2.3 trillion will be spent over 8 to 10 years. This is really, when they're looking at this, they're saying if we're going to provide relief, we also want to use this as an opportunity to rebuild and reimagine the country. And they're saying this is the most significant infrastructure bill that we've seen in the last 50 or 70 years since the interstate system was built, and also since we put a man on the moon. So this, if we can go back, this chart right here, you can see the pie chart right from the White House press release, how they broke it down, almost 40% to infrastructure, 30% to industrial policy, 10% housing policy, 20% to healthcare policy, and the remaining 4% labor. And you can see some of the numbers: $621 billion on transportation and infrastructure. That's your roads, bridges, and airlines. $650 billion on quality of life at home. That is for clean and fresh drinking water, also broadband. $400 billion on caregivers for the elderly and people with disabilities. So we see in the American Rescue Plan, and also Jerry alluded to it earlier when he talked about the New York State budget, about the home and community-based services. This is the continuation of that increase in that funding of the FMAP. What they're saying, in order for our country to be, over the next 50 and 70 years, I think everyone's very well aware, we have an aging population. We need to start addressing this infrastructure, how we can do it efficiently, provide jobs, good paying jobs and high skills to those providing the care, while our loved ones are being cared for. We can continue to work and add value to the economy. This is something big I think we need to watch, especially as a nonprofit community. So we'll go to the next chart here. Here's a comprehensive list of the allocation of funding. I think it's important when we think about this funding, what really the pillars are of this. And the three pillars that they're targeting are disadvantaged communities, social justice, and climate change. Really, the first two is what our sector, the nonprofit sector, has been doing over the last 50 to 70 years. So it's important we pay attention to this bill. So you might say, well, I'm not going to build a bridge. I'm not in the business of building highways. But you are in the business of saying, what is the right transportation resources for the disadvantaged? What is the right broadband that someone needs to use to get information subject to them? You can see about 2/3 of the way down, address the affordable housing crisis. I'm a board chair with an organization that we deal with this every day. I know many of you as well in your organizations say the affordable housing crisis. If we want to build up infrastructure, we want people to be healthy, it really starts with them having a safe place to put their head. So here's another opportunity for the nonprofit sector. At the bottom, workforce development. That's not just for manufacturing, high-tech jobs. Think about that as it relates to your staff and how you can retrain and retool them for the future. And it ties right into modernized schools and community colleges. Can you collaborate on programs to have some of your staff come right out of that, of the community college, and be skilled? So we go to the next slide, which is a polling question. So I'll take a breath for Mike.
The question is, FDR was subjected to an assassination in 1933. I believe that would be assassination attempt in 1933. True, false, or you do not know? John?
All right. Well, it's kind of interesting that FDR ties in because, as I said earlier, this is this is reminiscent of his New Deal plan back from the Great Depression. So how are we going to pay for this? The American Jobs Plan has the American Tax Plan, and I'm a nonprofit expert, not a tax expert. I am just giving you the facts as I see them. So they've talked about what they plan to do is increase the corporate tax rate from 21% to 28%. This is widely viewed as a point to start the negotiations, knowing that ultimately they probably won't get to the 28%. The other 5 or 6 bullets really relates to, they've looked at tax policy, they've looked at who is paying the taxes in this country, and they can see disproportionately that it's the individual and labor that's actually the one paying the taxes, while these multinational corporations are paying less and less and less taxes. This isn't supposed to be a conversation of supply side or demand side economics and who pays taxes or anything. It's just more or less the facts. But what they're saying is they want to disincentivize multinational corporations who make their profits here on goods and services from actually recognizing those profits in safe haven and offshoring to bring the tax dollars back to here. So that's really what they're planning when they talk about the taxes. And then lastly, what do we think the timeline for this is on the next slide? So Nancy Pelosi says she wants this done by July 4th. That would be 13 weeks from now. She wants it done in 1 quarter. I think we all know from this webinar series, they couldn't get the second round of stimulus done in 9 months. So are they really going to get this done? So I think that was just another aggressive timeline to get this going. Negotiations will continue through the summer and fall. And part of this right now is, even though there's the Democratic majority in the House, Senate, and also the White House, is right now they're not aligned. Some Democrats have said this does not go far enough to address climate change. Others have said it just doesn't go far enough. All we're doing is negotiating with ourselves. Why stop at $2 trillion? Why not get it to $4 trillion? There's no provision for SALT, the state and local taxes. That's big to us in New York State and the other high tax states. They did not put that deduction into this bill. So some of those Congress folks are asking where that is. And then there are moderates that are nervous about the increase on corporate taxes. And they're saying, hey, listen, it might not be as much the multinational, I get that, but that corporate tax rate, that goes to the small businesses as well. I'm going to have a tough time getting reelected in 2022, 24, 26 if we put through a tax increase. So that's what we know right now. Again, we'll continue to update you on this, and we'll stay apprised.
John, before I ask you a question, what is your position as it relates to how many years this is going to take in terms of investment in the economy?
Well, they've scheduled this to be 8 to 10 years. I think, ultimately, if this really plays out and they do invest $2 trillion in the economy, you'd start seeing the differences probably between in our economics, probably between years 5 and 20 in terms of having improved infrastructure, having, I talked about the caregiver economy, having the improved home and community-based services as well. It takes a while to build it up.
Okay, and the question is, given your board chair that you referred to, I think that's Habitat for Humanity, and the doubling of lumber prices over the last year, do you subscribe to my theory that people need to be more aware of inflation going forward?
2 months ago, I texted you and I was really nervous about inflation, saying what are we going to be discussing with our clients relative to inflation? The 2% to 3% is probably going to go away. How I look at this, though, is I've seen what some economists have said that we can also have a period of deflation just as easily. There could just be a one-time shock. I think some of it is also what we're seeing with lumber prices, other supplies and labor supplies. Once we can get these supply chains going back again, I do think we'll see the prices come back down. So I'm not as nervous as I was about a month or 2 months ago, but it's something we need to watch. And I think your comment you made earlier about you really need to look at the cost of your supplies and what that's going to be and how you're going to pay for it and finance it is something to pay attention to.
All right, thank you very much. We're now going to move to the person who is in charge of our Compliance Solutions Group. Many of you know him. There's a lot that we've said already about compliance with these various stimulus activities. It's a lot different today than it was when we first got into regulatory compliance 25 years ago. Paul Mayer is our subject matter expert in this particular area, and we thought it would be helpful for everyone to hear some of the changes that are occurring and some of what Paul has been seeing throughout the pandemic in terms of responses from providers with respect to certain questions. So, Paul, I'll turn it over to you. Are you off of mute? I hope.
No.
There we go. Is that good?
Oh, thank God you just gave me a heart attack, buddy.
Me as well. Hi, everybody. Good afternoon. Like Jerry said, this is Paul Mayer from our Bonadio Compliance Solutions team. And I wanted to shift focus a little bit and talk about some of the regulatory changes that have occurred, really not shifting focus, I guess. The New York State Social Service Law 363D, that's the law that governs the mandatory compliance programs here in New York State, was amended last April April 1st, 2020, with the laws of New York being approved. It kind of went under the radar. We've been doing our best to communicate those changes, and some of you probably have heard me speak on this in the past, but it's very important that if you are not aware of these amendments, please pay attention and have your organization go back to the Social Service Law 363D and read it in detail. Like I said, it was amended April 1st, 2020. It went into effect April 1st, 2020, and then there's some fines and penalties associated with the Social Service Law 363D that went into effect this January 1, 2021. Next slide, please.
Do you not see the next slide, Paul?
I don't. There we go. So some of the key changes we wanted to talk about related to the first bullet here, related to those entities that are required to have a compliance program. As most of you know, there's a dollar amount threshold of Medicaid dollars, annual revenue of $500,000 or more, direct or indirect of Medicaid dollars. Those entities are required and mandated to have a compliance program, and as well as Article 16, 28, 32, and 31 clinics. With the amendments of the Social Service Law 363D, they've added in managed care companies and managed long-term care companies. And some of the things that, from a compliance program perspective, a compliance program needs to meet the requirements in the law, the condition of payment from the medical assistance program. So one of the things that changed over in last year, as many of you recall, OMIG required an annual certification process in December. What has changed as of last October is they removed that annual certification, now have made it part of the eMedNY certification process in order to bill Medicaid. In the language in the certification form, many of you have seen, we've talked to many providers about this already. There is compliance program language in there that's saying by certifying and signing off on that form to be able to bill Medicaid for those entities that are required, you're agreeing that you have an effective compliance program that's applicable to Social Service Law 363D, as well as the New York State Codes, Rules, and Regulations, Title 18, Part 521. Again, those are regulations that support the law. The next bullet is a change, and it might impact many providers. Most of our providers, clients that we talk with, have a compliance committee. Now the law, Social Service Law 363D, requires you to have a compliance committee who reports directly and are accountable to the chief executive or other senior management. Next slide, please. So where some of that will be a change for some providers, and I'm not sure how this is going to play out down the road, but for those that have a compliance committee that's a committee of the board, the reporting structure to the chief executive or other senior management structure, that piece, we don't know how that's going to play out yet, but it's something to consider down the road when regulations come out, and we'll talk about that in a minute. Another key change is providers have to designate a compliance officer who reports directly and is accountable, again, to the organization's chief executive or other senior management. Where that's different from the prior law or before the amendment, and where it differs from current regulation, is that it no longer says that you have to designate an employee as a compliance officer. Now we're still waiting for regulations to be updated to follow suit with the social service law change or amendments, but that's a key component that could impact some of you down the road. If there's turnover in your compliance function, or you're looking for assistance, this could be a key component. The other thing that was added in, lines of confidential communication must also include first tier, downstream, and related entities. These aren't defined in the law, so once the OMIG regulations are updated, the Title 18, Part 521, we're looking to see some more clarification there. But, it just kind of goes to show you that your compliance program needs to be applicable to any related entity or, agent of your organization. Next slide, please. So this slide right here is a very key component of the amendments. The state has added some additional teeth behind the compliance program requirements. Effective 1/1/2021, you could be levied fines and penalties for not having an effective compliance program. That effectiveness is the key to everyone's compliance program. It's not good enough to have something sitting on a shelf. It's not good enough to say you have a compliance program. You have to have an effective compliance program, and you need to demonstrate how you deem it as effective. So fines and penalties now, first offenses, $5,000 a month up to 12 months. Subsequent offenses, or the second offense, $10,000 a month up to 12 months. So it adds some teeth, and so it's no longer is the cases of OMIG reaching out to people saying, you have this issue, we want you to make some changes. Now they're going to do that, but also potentially add some fines and penalties there. And also in the amendments, they detail the self-disclosure process and overpayment process. So again, I urge you to take a look at the full 363D law amendments and see what's currently in the law. Next slide, please.
We're on to a
So here's the polling question.
Are you aware that the Social Security or the Social Service Law 363D was amended as of 4/1/20?
Paul, while they're answering that question, I got two questions for you to answer quickly here. As you know, many of our clients have always felt that compliance was an unfunded mandate that was put on us many years ago. Given the changes that you've just described, what is your expectation regarding the percentage of providers that will outsource their compliance officer function now that you do not have to have an employee in that particular position?
I think it's an option. I think there's opportunities where in the past, if there was turnover in the position, an organization would look to someone internal, kind of bridge the gap. But now here's an option to look to external folks and that have the particular expertise. So there's not a fall off in the effectiveness of the compliance program. As far as outsourcing goes, I think it's an opportunity for some potential savings or different expertise that an organization may not have.
And you would agree that the outsourcing should be considered more by smaller organizations, let's say under 20 million in revenue, rather than the larger organizations that can afford that degree of infrastructure.
Yeah, I think it's good for part of an annual assessment process to review, like I said, the effectiveness, but also, what other hats is your compliance function wearing? Are they part of your HIPAA? Do they oversee HIPAA? They oversee IT or HR? What other functions are they responsible for? And are they able to carry out that key component of the law, that effectiveness of a compliance program? And if the answer is we don't know or maybe not, then I think it's a valid option for, those smaller organizations, but really any organization looking to be more effective, it's not only a compliance officer function, but also, other compliance-related activities that could be utilized from either teaming with another organization or using external outsourced experts.
Okay, thank you.
So as I mentioned, this is a review for most, but it's very important that, this New York State Codes, Rules, and Regulations, Title 18, Part 521, these are the regulations that support the compliance program requirements in the 363D. There's 8 elements. Most people have heard of the 8 elements of an effective compliance program. These are the components that are required. This is the law. It's just like any other regulation that you are bound to. And as we just saw a little bit ago, any one of these areas that's deficient could result now in some fines and penalties. You don't have claims that you have to overpay in this regard, but if you are deemed to any one of these areas not be effective, then you could be subject to fines and penalties. Next slide. So, like I said, the Title 18 Part 521 regulations, they're current. They've been been effective since 2009. So it's been quite a while that we haven't had an update to these regulations. Now with the law being amended, we're expecting this, and through our contacts, we expect this to be updated sometime this summer. So, it's important that not only, like I said before, you go in and someone vet through the law component, what is in the law, but also be on the lookout for these the OMIG regulations as they become available. You want to make sure that you address any changes that come out from the law amendments within your own compliance program. Next slide. And as a reminder, I keep harping on this effectiveness of your compliance program. This is critical. You need to define it, but the current regulations help you define what it should be applicable. So, you have to further define it, what that means to your organization. Obviously, a big health system, effectiveness is not going to be the same or defined the same as a small one program provider type. So it's really up to you to define how you deem your compliance program effective, and make sure that you have the systems in place to make sure that you are effective. And this is, on this page, it's an important piece of the regulation. Your compliance program should be applicable to billing, payment, medical necessity, quality of care, governance, mandatory reporting, credentialing, and then the catch-all that they so nicely have bolded for everybody, the other risk areas that are or should with due diligence be identified by the provider. That's kind of the catch-all. We preach and we promote the organization-wide risk assessment because you have many risk areas that are probably financially higher risk than some of the providers with Medicaid dollars. Whether it's HIPAA risk or other grants and contracts that you have to follow. So, your compliance program really needs to encompass organization-wide risk areas. Next slide. So one last thing I wanted to make note before we touch on some of our surveys that we've administered over the last couple of years. This is a reminder for those long-term care facilities, the 42 CFR 483.85, which are another set of compliance program requirements specific to, at the federal level, specific to long-term care facilities. These are effective November 28th, 2019. Excuse me. Again, defining the compliance program requirements and ethics program. I urge you to go back and look at those if you're not familiar of this update. But what's key here is, yes, that went into effect November 28th, 2019. There's also additional updates in the works from July of 2019 that are not yet approved. So again, having part of your compliance program and your annual review is taking note of these regulatory changes. We've talked about a whole bunch of things that have gone into place during the pandemic, but also another component is, who's in, excuse me, who has the responsibility to be looking at regulations, looking at laws, and making sure that you are addressing those areas. Next slide. So last summer, we implemented a workforce compliance survey it was just over 20 providers. It was a good source of baseline data for compliance programs, so you can get a sense of an aggregate what other providers, how you measure up with other providers in the community. We plan to do this again in the near future, to get some better data, but this is a good start, and you can start to look to benchmark some of your own compliance program. This is the first one was related to discipline. Do you have a policy that employees will not be disciplined for making a report in good faith? 11% either said no or were unsure. This is a training component of the requirements of the law and the compliance program regulations. Next slide. Do you know how you can obtain a copy of your corporate compliance plan? Where is it? Do you have access to it? Do your employees have access to it? And this is coming from the provider's workforce. This isn't your senior leadership. This isn't from us at Bonadio. These are what those organizations' workforce responded, and 18% either did not know or were unsure. Now, it goes back to that effectiveness. If you get an external audit and someone, a government entity, approaches one of your employees and asks, do they know where they can get a copy of the compliance plan? They respond no, you could be deemed as not having an effective compliance program. Next slide, please. Again, from our workforce survey, have you received information on the steps to be taken once a compliance issue is reported or suspected compliance issue is reported? 26% said no or were unsure. We're kind of lumping them both together because if an external entity goes in and asks your employees about this and they're unsure, that's as good as a no in as far as somebody external to your organization is concerned. Next slide. Do you have an anonymous hotline for confidential reporting of compliance issues? 39% said no or were unsure. Now that's a pretty large number that are not aware or are unsure of how to report or if you have a system to report compliance issues. Next slide. Another polling question.
Another polling question. Have you had a comprehensive compliance program assessment in the last 2 years?
Now this is a question.
Paul,
just want to make one comment, Art, before you talk. In the social service law, the amendments that took place last April and wasn't on our slides, but there's a requirement to go through an assessment of your compliance program effectiveness, and that's the key. You have to now formally, it's in the law, formally assess your compliance program's effectiveness. You might have your compliance officer, compliance team, or other senior leadership say that, oh yeah, we assess it every year, but you need to demonstrate proof that you've done so.
Paul, you mentioned early on that this was a survey of 20 organizations or more. Do you recall the number of respondents since we surveyed employees of those 20 organizations? What was the, if you will, the numerical response that we are basing these percentages on?
Yeah, it was several thousand responses from those individual organizations.
Okay, thank you.
So moving on, this is from our compliance officer survey of 2019. This one we surveyed just about 180 different compliance officers, or 180 compliance officers responded to our survey. And this one I thought was a interesting result. Does the organization's compliance function have a succession plan in place? 78% said no or were unsure. 65% said no. The compliance function, now has some teeth behind it, some financial penalties, fines and penalties. If you have turnover or, whatever it might be where somebody has to come in and take over, having a good solid succession plan where the compliance function responsibilities and activities are not lost, they're not going out the door. That's a critical component. Next slide. Is the compliance function involved with the organizational strategic planning process? 24% no or were unsure. Again, with everything that's been discussed today, compliance-related laws, rules, and regulations, different funding streams, and the stimulus funding and compliance program requirements, this is critical that you include your compliance staff, your compliance officer, in any strategic planning process. Different kind of mindset when you're talking about compliance of laws, rules, and regulations and contracts. 24% said no or were unsure. Does the organization provide enough resources to carry out the compliance function effectively? Again, another interesting component from our compliance officer survey. 44% said no or were unsure. Providing enough resources and putting enough dollars towards the compliance function is critical. I don't think there's any debate there.
Do you want me to cover this one, Paul?
Sure, go ahead. I was just going to talk about some of the audits. There's Medicaid is out there auditing, so we don't want people during this time to feel as if there's a reprieve. They are doing audits slightly different. Some of the timeframes we're looking at is January 2015 through 2018. There's 3-year audit universes that they're looking at. So it's a good time to focus on your internal auditing and monitoring because there is definite activity out there. Go ahead, Gary.
So on the Oprah audit slide, 32 behavioral health providers were audited over the course of, I think, the last 6 months. There was a technical violation identified in the processing of claims where the referring provider was auto-filled on the submitted claims. The position taken by the auditor was that these were not valid claims. If you expanded the 32 results for the 32 providers to all the behavioral health clinics, there could be as much as $150 million of claims that have been paid, services most likely properly rendered, that could be recouped. So we just wanted to make sure that everyone understood that this is still out there, and if we can't come to some rational solution to what it really is a very, very technical violation, it will most likely end up in some form of a judicial proceeding. And then I would close this section by saying that having been involved in regulatory compliance since the early 80s, it came into the Medicare program in the 82, 83, and then Medicaid in the mid-90s. This is an area where I think there are 2 risks for providers. One is that if you're deemed to not have an effective compliance program, I believe the New York State funders are going to be more forceful with respect to forcing you into an affiliation or a merger with a larger provider. And the second risk is that if you are audited and deemed to not have had an effective compliance program, everyone should know that a corporate settlement agreement can cost you literally hundreds of thousands or millions of dollars in order to comply with OMIG's requirements Those corporate integrity agreements are usually for a 5-year period, and you do not. You want to avoid a corporate integrity agreement like the plague. So while this area does not get a lot of attention in certain organizations, it needs to get more attention if you don't feel that you are measuring up to what these expectations are, and the expectations obviously are continuing to increase. Thank you, Paul. Did you have any final comments?
Nope, that's it. Any questions?
No, I think we're good. We're going to try and do the questions later. I'm going to go to certainly last but not least, our presenters on CFR cost reporting updates and some other important matters. None other than Terry Phillips and Mike Vollmer. So take it away, Terry.
Thank you, sir. So we're just going to do some real quick updates, some reminders, and some heads up things in the next 15 minutes. So take notes and we'll go from there. The due date is June 1st. It has not been extended. I've had a number of clients ask me if we think it will be extended. And the conversations I've been having with the state officials is they want the information in as soon as possible. They want to look at the financial health of the organizations. They saw the last year they were chasing a significant number of organizations after they gave the 60-day to August 1st extension, and then they were still chasing people in November. So they are steadfast that they want to get this information in as soon as possible so they can see what's going on in the provider community. They have not reinstated the penalties yet. So if you make an honest effort, we keep on going back with this, and there's letters that have been going out, but according to the two individuals from OPWD and OMH, they have not been instructed to send out letters and to start taking those instituting penalties in regards to late filings or late responses to CFR questions. And then lastly on this slide is we have seen a significant number of review questions that are different than last year. So they've changed their edits, both OMH, OASIS, and lastly OPWDD. So the 3 O agencies are really looking hard at the 6/30/20 CFR. So take note for the calendar year filers that are listening in, and that's important. And also they've been looking at prior year CFR. So we're spending more and more time digging up information from years ago, trying to get the right answers back to people going back to 2016. Next slide. This is really, we've been out doing our audits for the calendar year end providers, and this is for the O agencies, OASIS, OMH, OPWDD, and including the SED programs. And we're seeing a significant increase in financial positive results. And what I mean by that is we're seeing surpluses and cash balances going up significantly. And the factors certainly are the obvious factors. The federal dollars that have poured into the organization, the emergency regulations in regarding telehealth software services, significant decrease in costs, both staff salaries, benefits, and transportation costs have been decreased, and then the what I call the New York State and federal unemployment holiday for providers. So those coupled with just people just doing their ordinary jobs. If people are shuttered in place in an IRA, it's a lot easier to watch them as when they're out in the community and interacting. So that the staffing levels came down as well. So we're seeing a lot of different things that cause this, but primarily revenue, offsetting revenue for not providing certain services, coupled with a decrease in costs. Next slide. And this is what I said earlier. You know, in addition to the increase in cash investment balance, we had another strong investment year. We have a strong net assets position, and then really, the other thing I wanted to put here, we have our financial viability model, what we call the A score. It takes 12 ratios into account to complete this, and we've seen a 3 to 7% on average increase for the organizations that we've audited already, and that's very consistent for the most part. There are some providers, based on their programs, based on what they do as an organization, had an inability to cut costs as rapidly as a loss of revenue, and those would be those that are based in the community, those who have maybe large workshops or clinics. Those they appear to be affected at the Article 16 clinics specifically. Adversely, the Article 31 clinics seem to be actually improved somewhat because of the productivity. People didn't have anywhere to go. They were using telehealth to improve their productivity models. So as we work through this, we see a lot of different variations, and that's important to know. But if we're seeing it, the state's going to see it, and as we'll talk here in a second, you know, it's important to make sure that you're doing your documentation on your funding, the funds that you receive. If you're asking for forgiveness in PPP, or if you're getting an ERC or provider relief funds, making sure you're documenting and following the rules and guidelines in that. Next.
Only question. Prior to becoming the vice president in January 2021, Kamala Harris was the attorney general for which state? Washington, Oregon, Massachusetts, California.
So the next area is we're really talking about offsetting revenue, and I'm going to I'll do the lead in here, but I'm going to ask Ethan if he has any comments as well. We do know that SED and OMH have been very upfront in saying they're going to use these PPP loan forgiveness, FEMA, and HHS funds as offsetting revenue where they can. SED has gone on further to say that they are going to use it as an offsetting revenue in calculation of their rates on both the PPP and the emergency assistance for non-public school funding, but it'll hold them harmless in future years. So for SED providers, once the tuition rate goes down, it can't go back up unless it's a waiver is submitted to the cost screens and it's approved. They're saying they're going to hold you harmless against that, but it's important to note, if you're seeing large surpluses in those programs, that you might want to consider creating a liability for due to funder. Ethan, do you have any comments?
Yeah, I think that's phenomenal, just the way you said it. And, you know, just keeping track of the offsetting revenue is going to be critical in understanding current and future liabilities. So, you know, I think it was a great point. Great point.
Thank you. Sir, next one. Again, one of the other changes is OMH will be doing a 2-year reconciliation. They've already stated that, looking at their deficit funding contracts, and they want to see 2020 and 2021 to see what will happen. The OMH has many more deficit funding contracts than OPWDD and even OASIS, but the reason is OPWDD is very heavily Medicaid funded. In the OMH, a lot of their contracts are still state funded or funding, and that's the big difference. And I think the last thing here is that what I was trying to say here is that we really, with the large providers now, they really eliminated anybody over 500 before on a PPP loan. They were eliminated. They didn't get the funds. Well, with the new American Rescue Act coming out last month, what has happened is a lot of those large providers are now in the game. That is a significant amount of money. If they're approved and they are starting to get the payments, when that money comes in, I think that New York State is going to have to take a step back and say, what do we do now? We have very strong financial positions. People are holding cash. They have strong net assets. What will happen in the future? How do we react to that? How do we control our costs as an organization? Ethan, do you have anything else on that?
Yeah, this influx of cash flow to the organizations, to the O organizations, is definitely going to show up, especially as the CFRs are reviewed in the COVID-19 and COVID-19 schedules of the CFR. And it shouldn't be, and hopefully won't be construed by the state as necessarily surpluses, but it's just, there is different the CFR 2A will show, a lot more cash, a lot more assets. but there will be a forgiveness level and there will be oversight of the forgiveness, and who knows what the future will bring. So it's sort of, the hope is that it won't be intuitive to automatically reduce rates or restructure rates just because of the PPP and other federal funding.
Yeah, that's the things that we want them to resist from doing. And I am concerned that when they see, much like they saw with the CCOs last year, when the CCOs had to submit the CFR 2As in last May, they saw the amount of cash that was being held, and they tried to do the rate adjustments through that. So there is a cause and effect. You know, they look at something and they want to change it. So I just think we should note that and just be careful as we go through here. And I think certainly the advocacy groups will try to prevent any large cuts.
We knew this would be at least a 2-year reconciliation process. OMH, Oasis, at least had said that much. Now with PPP1 becoming eligible for so many new providers, it's likely going to extend out into the 3-year reconciliation process. So these things aren't going away for quite a while. There's going to be quite a while before we get real down paper pencil answers on some of these things, unfortunately.
Yeah, the other thing I saw was OMH, the counties starting to try to catch up. A lot of counties were very far behind in those county contracts from OMH, and then they're trying to close them out. There are a number of them were 5, 6, 7 years behind. And when the cash started drying up coming from the state early on in the pandemic, they were putting pressure on them to get cash into the county and to close out those years, because they knew a number of those providers were sitting on cash that they owed back to the counties. So that process, I was following it early on, and I have not followed up on it, but I do think that you're going to see, depending on what happens to those counties, the pressure to continue to collect that money sooner.
Yeah, if I could just add one more thing, Terry. In the analytics on these numbers are going to be really like a roller coaster, looking from prior pandemic to pandemic years. And organizations should just be real careful to know what they blame on the pandemic, because if there's any of those costs that would actually continue subsequently, if it's a higher rate or some kind of additional pay or benefit that you might think might continue afterwards, you should have some good documentation to explain why post-pandemic you're still going to have those costs, so that the state doesn't come back and say, well, you told us last year and the year before this is all specific to the pandemic. So just be real careful how these things get documented and reported.
Next, don't I have a new slide?
Yeah.
So the important thing, just this leads into for Ethan, what he was just saying. What we're seeing early on is not a lot of effort going into the COVID-19 S schedules. We really think you need to make sure you're completing these. Make a reasonable effort to complete this as accurate as possible. You are spending that money, and you need to take the time to break it out by programs and to lay it down. They want to know that the money they spent was invested properly, they being the state, and these schedules help them see that. And on the COVID-19S, they also want to know what happened when the school is shut down. What money was saved? What costs? Was there savings in transportation? Was there savings in food costs and teacher aides? They want to know what was going on, and so they can make informed decisions. I think, in all fairness to ourselves, we need to make sure we're being put a reasonable effort in helping to them get that analysis. And then lastly, on cost allocations, our favorite topic with me is, what I see is sometimes a little bit being too creative on the CFRs and how do we allocate costs, especially when you have a lot of money coming in. So as we look at this, we really want to be using the appendices J and L for guidance. It's not the Bible, but it's a reasonable starting place. And you start there, and if it doesn't fit your schedule, you need to justify why. And maximization of revenue doesn't count. That is not a reasonable cost allocation methodology. In fact, that is what I would call fraudulent activity. So the reason what you need to do, take time to do this, is really what's reasonable for your organization, and starting with those appendices, they're very clear on what they want to do. Let's make sure we're following a methodology that's reasonable and consistent over time, and not changes because I had more money this year. Ethan, or go ahead.
Can I add to that?
Yeah.
These are the kind of things that when we talk about risks, don't go through and for financial reporting purposes account for all this one way, and then get to the CFR and say, oh geez, I got to do this a whole different way, and have a situation where your CFR reporting and your audit, your external GAAP reporting are totally different. That is going to lead to problems. You have to think about this stuff and have some consistency between all the treatments.
Yeah, that was exactly the point I was just going to bring out. You know, when we were originally designing the indirect cost rate manual in New York City, that was one of the points that came out, that there are so many different methods that we may be required or allowed to use in terms of allocating costs between program and administration, just as two general buckets. And you just have to be real careful how you do those allocations per funding agency and per reporting agency. And a good example might be someone who does billing. Are they program or are they admin? And you might get two different answers, and both might be right from two different agencies. So just something to be mindful of.
This last slide is a potpourri, if you will, of topics that we just wanted to make sure we closed with before we go into Q&A. We do not believe that there will be a rebasing or recalculation of rates for OPW providers as of July 1 of 21. The transition to managed care continues to be delayed. I'm one of the few people that was around in 1992 when the state of New York threatened to bring in the publicly traded company ResCare out of Colorado to implement managed care in New York State for IDD. We started once again in 2008, so we're 13 years in talking about managed care for people with IDD. And I believe that, again, bet is the right word. The best bet right now would be 2023. And that assumes that we are through the pandemic by the end of this calendar year. Care coordination organizations, which many of you know, took over your Medicaid service coordination back in 2018. There was a proposed 23% cut in rates that was not enacted or not adopted in the budget. However, the 16% rate cut that was implemented as of July 1 of 20 does remain in place.
But hasn't been implemented yet.
But it has not been, I'm sorry, say that again.
Has not been implemented. They hadn't taken
They
back.
haven't taken the money back yet, so
They
the money
adjusted
still
the rates.
rests in the
Yeah.
coffers of the CCOs.
Yeah.
The workforce crisis, I've talked about this many times in my comments relative to inflation, et cetera. And I do believe that the smoking gun, if you will, for inflation for many providers, since the majority in many cases are direct service professionals, $15 is going to be here sooner than you might think in upstate New York, having already been implemented in New York City back at the beginning of 20. I'm going to ask Terry to give you his prediction on whether or not there will be a OPWDD rate methodology change, moving away from rate rationalization in favor of regional rates. Your prediction, Terry, is what?
Yes. They
Would
did
you like to comment further than yes?
I think what I would say is they didn't like the results they got under rate rationalization. And by the time it was implemented, 2.5 years later, it was outdated information, especially when it came to the people that were being served, hours, and then it was the rate rationalization was subject to a couple of things. One, the economy. And when unemployment dropped down to a very low rate, there was a significant amount of vacancies. So it changed the number of hours that were involved to give care. And it was also subject to if a provider, a senior provider was having a very bad year, high behaviors, high costs were going up, and it was a base year, they were stuck with that cost for the next 3 years. So there had some points that benefited certain providers and hurt other providers. So they didn't like the result. In the end, they also spent $90 million more than they thought they were going to spend. So you take those variables over here, they wanted to have a better way of predicting their costs, and that's why you're going to have a rate methodology change. Probably later, I think it's going to be 2022 before they get to it, but I do think it will occur.
And can you tell us what add-ons might be considered for the regional rate methodology? And can you also comment on where we are with the implementation of the coordinated assessment system for being able to assess acuity levels of individuals being served?
They're still struggling with the coordinated assessment tool, and I'll ask Ethan if he's heard anything different. They're still working on it. I'm not sure that they've abandoned it, but I have not seen it being spread out to where they want. And then the parts they will consider, they certainly have to get under control, is a reasonable methodology to what they call the acuity factor, but they have to calculate person's needs and the mix of the needs in a organization. How do they get there? I think that the intent last year was good, but it didn't get to where they wanted to go. So we're seeing organizations who get very disrupted because they're taking on priority one organizations. We see homes and rehabilitation programs and other programs that are really stressed out. So until there's a method of compensation to the provider that works and it's reasonable and can change to someone on a timely basis, they're going to struggle with getting those people down. But I do think that will happen.
Ethan, before you comment on this, I'd like to ask you, we haven't talked about this, but the complaints about the coordinated assessment system for OPW was that it did not properly gauge or assess the behavioral health needs of individuals with disabilities. I know that they've been tweaking it for the better part of a couple of years now. Could you comment to the extent you know on where you think the coordinated assessment system is going and whether it's going to be used or whether we're going to move to some other model for purposes of replacing the DDP scores?
Yeah, I think it's going to turn to some sort of a hybrid model, because as this came about and it's been morphing over the recent couple of years, they've been seeing differences of opinion from the DSPs and others that are involved in the assessments, and they have to just try to bring all the mindsets together, whether it's coming from a funding or a direct care or a supervisory care perspective. And so that's going to take some time for them to iron all that stuff out, but it's definitely I'm hopeful that it'll be a hybrid model.
Thank you. Now I have, before Mike, Jimmy Fallon, and Valmer asked some more questions, there was one question that I think freaked out half of our audience when I mentioned that admin costs are going to be pushed down to 12 and maybe even to 10% as we go forward here, not just OPWDD, but all the O agencies. That comes on pretty reliable but off the record conversations. We've been negotiating managed care contracts with insurance companies for the better part of 15 years now in various service sectors. And the managed care organizations are dead set on 10%. The question that was asked in the chat box was, which one of the 4 methodologies for calculating administrative costs are going to be used for relative to the 10%, the 12%, or whatever calculation is going to be used? Is it going to be EO 38? Is it going to be the CFR? Is it going to be Form 990? Is it going to be some individual calculation that's adopted by the various O agencies? Or is it going to be mandated and dictated by the insurance companies? I believe there needs to be some decision made in that regard. It has not been made yet. So when you talk about 10 to 12% administrative costs, depending upon the methodology that you use, some can get well under 10%, some can be well over 12%. I was told that 37% of providers in the city that files CFRs are over 15% in terms of the calculations relative to the CFR recipient agencies. So it is a significant issue. It doesn't mean it doesn't exist upstate either, but it is a major issue down in the city with respect to those providers, many of whom are less than $20 million in revenue. And you can do the math. 15% of $20 million is $3 million. You've got to do your entire C-suite, HR, finance, compliance, IT, blah, 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 for $3 million in New York City. You go down to 10 million, it comes to be $1.5 million. And that is what I think is the other smoking gun that exists as we move forward here, as the state continues to move in the direction of reducing the number of eligible providers. And I think they're going to do it in multiple ways. Some of it's going to be done through MCO, managed care organizations, not contracting because they don't need you. We've had MCOs tell us that smaller clients are not needed in their network. And so this is something that I think has to be communicated very clearly within your management team and to your board. And I'll put one last shameless plug in for the Business Journal column that'll be attached to this slide deck. I think should be provided to every board member in the organizations attending this, particularly board leadership, because it does address in English the very complicated areas that we've talked about today with respect to clawbacks, recoupments, double dipping, what type of information should be communicated to the board in a dashboard format. And if you do that now, you can protect yourself from the Monday morning quarterbacking that may occur after the government agencies catch up with respect to how much money they are deciding to recoup or clawback or have treated as a double dip. So it's a very important, in my mind, article that can be provided to your board leadership. And certainly I am impressed by it only by virtue of the fact that I've had, and I never get emails on my columns. I got 5 emails from treasurers and board chairs of clients who said that they did not understand what I had put in the article, but after reading the article, they understood it very clearly. So I believe the article is something that should be widely distributed. Back to Mike, Jimmy Fallon, Vollmer.
So we have one polling question I'm going to launch and then do a couple of quick questions. I'm not going to read poll question just to save a couple of minutes here. So this question is for John, but I think it could apply to anybody else too. Given the large federal dollars that are available currently, is now a good time to start seeking funding for some large capital projects?
Well, I think the question came in when I was talking about the infrastructure plan. First thing to remember is the infrastructure plan does not actually cover construction or capital projects. But as Jerry has said today, Margaret said today, you got to look at what your organization is going to look like. Telehealth is sped up by 10 years. Right now, we're still in that pre-inflation. We're looking at very low interest rates. I'm not going to recommend to your organization what you should and shouldn't do, but I would strongly recommend how are you going to be operationally and financially sustainable for the future, and what type of capital investment you need to make and how you're going to finance that.
Thank you. Jerry, what do you think the likelihood is of extending the public health emergency beyond this month? And what will happen to telehealth for Article 16 and Article 28 clinics if telehealth is not extended, or if that public health emergency?
All right, so they've got these variants, the UK variant being the dominant one right now. Until they get those variants under control, which I don't believe will happen until the 4th quarter of this year, I believe the public health emergency will be continued. And I also believe that there is so much momentum in the legislature for what people have seen. Basically, everybody's been exposed to Zoom or some form of video conferencing or telemedicine, telehealth. And the amount of acceptance of that that's occurred over the last 12 months makes it very clear that I think we are going to have, sooner than we would have ever thought before, parity when it comes to telehealth and telemedicine visits. I go back to the early 70s when physicians started asking insurance companies if they for phone consultations, and phone consultations were basically put on the shelf for the better part of 40 years. We are now in a different world, in a new normal, will be that telehealth and telemedicine, now keep in mind, there are some efficiencies associated with telehealth and telemedicine. So when they talk about telehealth and telemedicine parity, just because you're getting paid a certain rate for a clinic visit now, don't necessarily expect that the telemedicine parity rate is going to be the same. In some cases, it's going to be less. In some cases, it will be the same. And in certain cases, it may be more than what you're paid for a direct face-to-face visit.
Margaret, question for you, please. HHS updated their 331-21 discussed, the update on 331 discussed cost-based reimbursements. Are these considered dollar-for-dollar reimbursements or programs that have a daily rate, such as hospice?
So this is definitely a tricky issue, and the language in the FAQ is not very clear on what the treatment of these are. But generally speaking, so if you have a critical access hospital, for example, who submits their costs via a cost report, and then the cost of the Medicare patients is calculated, and you're reimbursed that exact cost or 101% of it, then you wouldn't have any excess expenses for those patients because you are going to get reimbursed in full for those. It becomes a little trickier when you're talking about PPS reimbursement or even things like New York State Medicaid rates that are, I suppose, technically cost-based, but the costs are based on maybe 2007 or 2009 cost reports. There is a section in the FAQ that talks about if there's a ceiling or if there are still non-reimbursed costs, those could be eligible. So in those cases where your full cost isn't getting covered, I think you can make an argument that those COVID-related expenses would be allowable. The other thing you can do that they show in the FAQ is if you take your costs pre-pandemic and figure out a cost per visit or a cost per day, that kind of thing, and look at your reimbursement per day. As long as, you know, if you're making $5 a day, let's say, and then post-pandemic, you're losing $5 a day, there's a $10 swing there per patient day. So you can look at that as your increased cost and apply that to your PRF funds.
Mike, we have time for one more question. It's 2:04, and we appreciate the people that are staying with us.
Sounds good. I will waylay the question about whether you can talk more about the transition to managed care, because we don't have time for that one. But
well, plus it's a crap. All I'll say about managed care is it's a crapshoot right now, and the CCOs, DOB and DOH, as well as Commissioner Kasner, have to get on the same page before we can move forward as to whether it's going to be CPL linked to Article 44 insurance companies, or whether Commissioner Kasner's model is going to go forward. Two very different models at this point. They have to compromise.
One quick comment before I get to this question for Terry. There is some fairly specific questions here that we're happy to kind of address with you offline. We're a little bit too in-depth for right now, so please feel free to connect with whoever in this room is probably the ideal person for those, you know, who you are. Terry, for fee-for-service, ComHab, respite, do you believe those rates are not going to change until 2023, either up or down?
I think they're going to have cost of living increases. I think they're going to get part of the FMAP savings that came out of the American Rescue Act. So I think they are going to be impacted. How they're going to be impacted, I'm not sure yet, but I do think they're going to go up. How's that?
Good enough. Jerry,
I'll just make one final comment here. I appreciate all the people participating here. We will have a session, as I said, in May, probably the third week of May, Friday. If you do have comments with respect to the length of our presentation, 2 hours versus 3 hours, please give us that feedback. You will have access to the slide deck and the recording. I just learned today during this presentation that we have our own YouTube channel, Bonadio Group, for past webinars that have been presented. And we would certainly appreciate any feedback that you could provide as to how we could make these more beneficial for you, and specifically related to topics that you would like us to cover. We are committed to obviously providing as much support as we possibly can to the tax-exempt providers in New York State. And we certainly wish you all a healthy, safe, and happy weekend. Thank you very much, and thanks to my co-presenters here.